I'm here with Abhay today, and we are going to talk a little bit about product, but more importantly, a competition, a trading competition to be exact, in which he entered and used a lot of the strategies that he's implemented into product, into the real world of manual trading, which was public for everyone to see. Can you tell us a little bit about the Leap competition that you entered in on TradingView?
Hey Matt, thanks for having me on. For sure. So Leap was a challenge created by TradingView for the month of April, and they worked with a broker called Pepperstone, which sponsored the challenge. They gave you specific instruments to trade and specific trading conditions, and the goal of the challenge was to create maximum profit on 250,000 simulated capital for the month of April.
And how well did you do amongst all of the competitors?
Yeah, so I came in the top 8% and did about 17.35% profit for the month of April.
Very impressive. And how many people were actually in this competition?
Almost 40,000. I believe the final number was around 38,000 something.
Wow, that's very impressive. So I actually want to ask you, considering that you had to trade amongst 40,000 plus people and it was manually, how much labor did that require versus running an algorithm? Would you be able to draw any analogy between the two?
Yeah, definitely. I think the algorithm, they're very hands-off. Of course, nothing's hands-free. It still needs a little bit of monitoring the account, but they're mostly just hands-off. I think on average, I would say the upper range of how much effort someone would need to put in as a client would be 30 minutes a day. And that's the upper range. The lower range would be like 5 minutes. On this challenge, I think on average, I spent about 2 to 3 hours a day.
2 to 3 hours a day. And you are a obvious skilled trader, so you know exactly what to do and how to trade. A lot of the people typically don't have that experience, so it would take a lot longer than 2 to 3 hours to find the opportunities in the markets that would present themselves to take these trades. Can you tell us a little bit about the strategy behind the trading that you used to take these positions, and what assets were you trading?
On the challenge, there were 11 assets that were allowed. So it was BTC, Solana, ETH, a few of the indices, which was US 30, the German DAX, Hong Kong index, and there were also a few USD pairs. So I was primarily focused on US 30, on the USD pairs, and on crypto, and on gold as well. So that was, a big portion of the trades.
And what was the strategy behind it? Was it just support buys and resistance sell, or?
Yeah, lots of different things. I mostly trade two strategies. One's a trend following strategy and the other is a reversal. Most of the trades on this challenge were trend following. And it was primarily, I think, a bit fortunate timing too, with the stock market taking a huge hit because of tariffs.
Yeah.
So I just was following the trend. Really. I think most of my trading activity came in the first part of the month, because what people generally traders, they try and trade in the sense that their goal is to constantly be doing something to trade and generate profit. Whereas I think what I've realized just over the years is it's actually better to be patient, wait for the right opportunities and go in with bigger size. So the middle of the month, I didn't really have any trades. There were days where I wasn't even paying attention to it. But on the start of the month, I was very, very active, and some days were spending a lot of time on it. So it's just because the opportunity was there and the market was trending. So I just capitalized on the trend. Crypto was going down, stocks were going down because of tariffs. And I was just trading in and out with the trend.
And I want to ask you, what amount would you say of that strategy has spilled over into product? Because of course this is manual. Does that reflect into the product in which these people and myself are licensing, or is it completely uncorrelated?
It has a decent level of correlation on the technical strategies that we have. So the newer strategies in Intelligent Trader like Algo, Odyssey, Buterin, they're very much AI based. So they don't have too much of a technical component, but our other strategies such as Dalio, All Weather, which Dalio forms part of All Weather as well, have portions of these technical aspects that we look at when we take these positions. And a big portion of what we worked on with Dalio version 3 that's almost ready to launch now it's in final stages of testing, and was redoing the sequence of how it scales into positions. So we took what we trade manually from a reversal perspective, because some of the trades in the challenge were reversals as well. And we looked at what specific conditions do we look at when we manually take reversals, and we incorporated them into the sequence. Because the previous sequence of what we had with Dalio used to scale in pretty quickly, and it was, scaling in at a higher pace as well, or higher frequency. So when the market strongly trended, that resulted in higher drawdown. Whereas now, even in a strongly trending market, we only take positions against the trend when the algorithm senses reversals, which is based on very much how we manually trade reversals as well. So it's a lot more strategic, and it will progressively scale in when it senses that the market is ready to reverse.
Okay, so I just want to make a parallel here. The head of product at Nurp, who develops the trading softwares, is also trading, and he's developing these products. When we look at a lot of companies across the board that maybe issue some type of trading solutions to help people trade automated, chances are they're probably just buying softwares. Is it safe to say that you are actively implementing these strategies into these softwares in which you guys are developing in-house?
Yeah, absolutely. Because we actively trade the markets ourselves, and our founder, Jeff, he has a hedge fund too that we actively focus on. So we are very much aware of how the market's changing, what kind of conditions we need to look for, and we incorporate more and more of what we do on a manual basis to make it automated so that clients who are running the strategy are getting the same level of advantage or skill set from a professional trader, but they don't have to go and spend years in learning trading,
I really think that people will soon realize that the solutions in which you guys are offering are by far the most qualified for anyone to test on their own and see if they work, because of just your background, Jeff's background, and a lot of the people inside of the product team and their extensive research that goes behind these products. Speaking of extensive research, can you tell me a little bit about some of the drawdown events or max drawdown events? Because that's one of the things that come to mind when people are looking at products. What is the risk, and have we ever seen any risk being involved with these products? Can you touch on some of the backtesting on drawdown specifically?
Yeah, absolutely. I would say nothing is risk-free, of course, but we've done rigorous backtesting on our strategies, especially on the new ones that are just launching. I think those are more timely to talk about. So Dalio V3, like I just mentioned, we looked at all the trading pairs that we're trading within Dalio, which is 10 pairs. And over the last 10 years, for each of the pairs, what is the most strong adverse move in one direction? Because of course, if we have a sequence scaling in, we want to know what's the strongest trend over the last 10 years and how did the algorithm fare during that trend. So we looked at the worst move in terms of how strong it was in a single trend for each of individual pair in the basket of trading pairs for Dalio. And some pairs had 6% moves, some pairs had 8% moves, some pairs had 21% moves like Euro AUD, and the algorithm handled that 21% move with less than 25% drawdown, which is extremely impressive, because when you have those kind of adverse news-based moves, it's very, very difficult to trade a reversal on them. But the algorithm was able to strategically scale in. And the really interesting part was in this new version of Dalio, even when your AUD was trending really strongly, instead of the previous version where it would be scaling the whole way through, here, there were increments where we had gaps of 4 and 5% where the algorithm didn't take any trades because it recognized that the trend is to the upside. So I shouldn't short here. I would wait for where the price action is reversing. And then it started taking short positions.
This back testing and everything you just said here, over what period of time has that been tested for?
10 years. Start of 2015 to end of 2024. And not only the 10 years, we looked at each individual pair level and looked at the history of the 10 years and investigated what was the worst, most trending move, which would have really caused drawdown, because the drawdown is caused by a strongly trending move in Dalio because of the sequence. So we analyze each pair at a pair level to see what's the absolute worst move over the last 10 years and how did the algorithm fare, how much profit did it make during that move, did it take a small loss, how did the hedging protect the sequence, how were the entries placed during that time. So we mapped each entry level and essentially looked at, what we can tweak and change to improve the entry sequencing to make it more strategic.
Impressive. Another thing I'd love to just draw for the audience here is you mentioned Dalio V3. That means version 3. So to put that into perspective, that means there's been 3 iterations of a single product, meaning that we're always building and advancing our products. Meanwhile, a large portion of the market is just boxing up something else from someone and then giving it over with a fee. I have extreme admiration for you guys continuously building. What could we expect that is different in V3 versus V2 on the Dalio?
There are a few things that are different. Firstly, I think the biggest change is that we built the entire sequence from the ground up. And that was a very, very extensive project. A lot of financial resources, time resources that went into that. It's based on, like I said, strategies that we manually trade when it comes to reversals. So we've been trading that for years and years. And the same metrics that we look at, we incorporated that into an automated method. And that's why we can stand behind it, because we know we manually seen those setups again and again and again. And also, I think from the other aspects that we worked on, not just the sequence, the entry is very similar to what we had before. The other aspects were more on hedging, because that is a big part of the strategy as well. So now in a very strong trend, let's say a pair is having a 20% move, it may actually take a small loss to protect the account. And by small, I mean 2, 3, 4%. The worst we saw was 4.5%. And that's because the hedging is protecting from a bigger drawdown, a bigger realized loss of like 20, 30, 40%. Because that's what we don't want, because that sets people back if they do take a loss like that. Whereas if it's a 4% hit, we know that on average, if it's doing 3 to 4% a month, we'll easily recover that in a month anyway. But that 4% hit was really only once in 10 years. It's not something that happens frequently. It's just if there's some big news in the market, like what we saw with the tariffs, and an asset becomes really volatile and trending, it will use the hedging to protect against that, and the new entry sequence to make it more strategic. So overall net result is you get a much, much better risk protection on the algorithm.
So in, I guess, layman terms here, its scaling ability has changed and its mechanism in which it hedges has changed for optimizing its drawdown, which is essentially the most important thing to longevity in the market, correct?
Absolutely, yeah.
Awesome. That's great. I guess the last thing I'd like to ask you before I let you go, because I know you probably have a product meeting in maybe 10 minutes here. What are you most excited about coming out of the product department?
Yeah, I think the biggest thing that we have coming out, or is already live now as of yesterday, is the all-weather strategy. And effectively what we've done is we've looked at multiple uncorrelated algorithms which have a long track record, and we have rigorously backtested to ensure that clients get a diversified portfolio. So instead of one algorithm, they can run one account, which would be concurrently running 6 algorithms inside of it. And that's what we've done with all weather. Some of the strategies are built in-house. Some we've partnered with other developers on as well, and presented a portfolio of 6 algorithms running together, managed in a way where the risk across the capital is spread across them very strategically. So not each algorithm has the same weighting on how much capital it can use out of the account. So it's very strategic. But that way, one, the performance is higher because you have a lot more activity in the account because you have multiple algorithms running at the same time. And the drawdown is lower because each algorithm, when you look at it from an individual algo perspective, is running at lower size. So this way, clients can just run one strategy, which gives them access to 6 different algorithms running together in a very intelligent way, where they're managing capital and weighting across them and risk across them as well. And they can just run one. And we actually backtested the all-weather portfolio or all-weather strategy, whichever we want to call it, through 2008 and through 2009 as well. And in 2008 was one of the worst financial crises that we've seen, at least over the last 50 years. So one of the most volatile markets we've seen. It did 28.5% for 2008, the annual return. So of course there were some small losses when you look at it from a month-to-month basis because the market was just very, very volatile. But on a yearly basis for all of 2008, that all-weather portfolio did 28 point something percent return. And then 2009, it did 60+% return. Wow. So even during the worst years, and we backtested it through 2009, 2008, like I said, and then all the way from 2015 to end of 2024, and then even during March 2025, the first quarter of 2025, which was quite volatile too. And the max drawdown over all of those periods was about 17.5% because we risk control each individual algorithm inside of the portfolio in a very robust way, such that let's say a particular pair goes into drawdown and it goes into 7, 10, 8% drawdown around that mark. So it depends on which algorithm. It will automatically close the positions and protect the account. So that way, when you have 6 algorithms running together, let's say one takes a 7% hit on the account, as in a 7% loss, the others would make a few percent profit that month. And then the overall net result would be on the month, you might be minus 2% in an extremely volatile market. Whereas most of the time you'd be, plus 4 or 5. The average on that account was over 5% per month over the last 10 years. And that's because you have a lot more activity and then you have much better risk protection. It's, I would say, the most amount of backtesting and rigor that we've added to any particular strategy that we've ever released. And I just want to also clarify that we just call it all weather, but effectively what it is it's a portfolio. It's a collection of 6 different strategies or 6 different algorithms, all running concurrently, managing risks in a very smart way, and also providing a lot more opportunity for profit because there's just so much more activity on the account because you have 6 different uncorrelated strategies running.
That last segment of you just explaining exactly what it is makes me excited about it. So this is currently active. Can somebody gain access to this?
Yeah, we went live with it yesterday. So it will be up on our MyFX book, I would say today or Monday. And clients can license it. Existing clients can license it right now. And then new clients would be, we're still working out the pricing structure on it. So more information coming shortly. But as far as our existing clients go, they can license it today.
Amazing. Well, Abhay, thank you for your time today. And I'm excited to see how well this performs. I will be tracking and documenting an all-weather portfolio live on the channel for everybody to watch. And again, thank you for your time. I hope to speak to you soon again once this is fully out and running over at least a 60-day span.
Thank you, Matt.
Thank you. Now, if that sounds interesting to you and you want early access to use a product like that to diversify your portfolio and help mitigate your risk, meanwhile keeping a lot of the performance still intact, down in the description, there's a link that will give you early access to this product. There is only limited slots for this product, so you don't want to miss out. See you in the next one.